Business transactions. Businesses engage in exchange of various goods and services. Payment may be immediate or at a later date, depending on the policy of the business. The main type of business transactions are cash and credit. Introduction. When exchange of goods and services take place, payment may be affected immediately or after an agreed period of time. Such transaction affects the items of the balance sheet either by increasing or decreasing. Meaning of a business transaction. This is the exchange of goods and services for money considerations between a buyer and the seller. Types of business transaction. There are two types of business transactions: cash and credit. Cash transactions. This is when the payment for goods and services is done immediately after exchange. Payment can be done through cash, check, credit cards, postal order, money orders, and money transfer services such as M-Pesa, Zap, UCash, and EcoPesa, among others. Credit transactions. This is when payment for the goods and services is done at a specified later date. From the seller's point of view, it is a credit sale, whereas from the buyer's point of view, it is called a credit purchase. Effects of business transactions on the balance sheet. The balance sheet comprises of assets, liabilities, and capital. Whenever cash or credit transactions take place, they may affect assets, liabilities, or capital of a business. This therefore means balance sheet of a business and the transactions that take place are directly related. Effects of a single transaction in the balance sheet. Single transactions may affect items in the balance sheet in the following ways. It may increase an asset or a liability. It may decrease an asset and also a liability. It may increase one asset and decrease another asset. It may increase one liability and decrease another liability. The following is a balance sheet followed by transactions to illustrate the concept of effects of business transactions on the balance sheet. The following transactions took place. Took loan worth 50,000 Kenya shillings and deposited it in the bank. This transaction will affect bank loan and the bank. The effect is bank loan increases by 50,000 Kenya shillings. Cash at bank increases by 50,000 Kenya shillings. Paid Wambua Traders' balance sheet will be as follows after the transactions. Causes of changes in capital. Capital is the value of assets of the business that is contributed by the owner or owners of the business. It can be in form of liquid money or property that the owner or owners bring into the business at the beginning. The value of capital can increase or decrease over time in the course of business activities. Some transactions increase the capital while others reduce it. Additional investments. This refers to any addition of money or property into the business. This increases capital. Profit. Profit realized by the business increases capital. Drawings. This refers to money, goods or services withdrawn from the business for personal use. This reduces capital. Losses. Losses result when the cost of goods or services is higher than their sales, leading to decrease in capital. Initial and final capital of the business. Initial capital refers to owner's claim of the business at the beginning of a trading period. Final capital refers to the owner's claim at the end of the trading period after the adjustments. To determine initial capital of a business, the following procedure should be followed. Financial capital, that is FC. Add drawings, that is D. Less additional investment, that is I, or profit, P, is equal to initial capital, that is IC. In case of profit, IC is equal to FC plus D minus P minus I. In case of loss, IC is equal to FC plus D plus L minus I plus I. Procedure followed to determine final capital. Initial capital, add additional investment or profit, less drawings or loss gives us final capital. FC is equal to IC plus P plus I minus D. Procedure followed to determine final capital. Initial capital,